Welcome, traders and market enthusiasts. Today, we're diving deep into one of the biggest challenges in trading, timing your entry after spotting key levels. You found a key level. Now what? It's common to see many traders freeze at this critical juncture. They identify support or resistance, and then, often in a moment of panic, make an entry that's either too early or too late. Entering prematurely means you might get stopped out, while a delayed entry can cause you to miss out on a significant move. In today's session, I'll share with you the top 4 entry confirmation strategies that professional traders use to time their trades perfectly. Forget the guesswork and the FOMO. It's time to turn those key levels into real profits. So, if you're ready to sharpen your skills and trade like a pro, make sure you hit that like button, subscribe, and drop a comment below. Let's jump into strategy number 1, the approach that even institutions use to trap retail traders. Let's start with strategy 1, turtle soup, also known as the false breakout trap. Picture this: price breaks above or below a key level, and just like clockwork, traders rush to join the move. But here's the twist: shortly after the breakout, the market reverses, catching those early entrants off guard and triggering stop losses. This predictable reversal is what we call the turtle soup setup. Why is it so powerful? This strategy works because it capitalizes on a phenomenon we refer to as a liquidity grab. When price briefly breaches a key high or low, it's designed to attract traders into a trap. Once enough positions are built, the market reverses, sweeping away the false breakout entries and rewarding those who waited for confirmation. Let's break down the process. Spot the trap. Look for a situation where the price sneaks past a recent high or low. This initial movement is often a liquidity grab, a deliberate push to entice traders to enter. Wait for the rejection. After the initial breakout, the price quickly reverses back inside its previous range. This rejection is your first sign that the breakout was false. Confirm with fair value gaps. To add more precision to your entry, look for fair value gaps. These gaps indicate areas where the market skipped over certain price levels, usually due to strong institutional activity. Now let's bring this to life with a live example. Imagine a chart where the price dips below a well-established support level. The sudden drop creates a moment of panic among sellers, who jump in, expecting further declines. However, the market then quickly reverses, and the price rallies into a region characterized by a clear fair value gap. This gap, where the price seems to have skipped levels, signals institutional urgency. In this scenario, you position yourself by buying at the gap, placing your stop loss just below the trap. The result? You ride the ensuing bounce, turning the initial trap into a profitable opportunity. Take a moment to visualize this setup in your mind. By recognizing the signs and waiting for the reversal confirmation, you're essentially letting the institutions do the work, and then you jump in at just the right moment. This strategy is a powerful reminder. Sometimes, waiting for the market to confirm its move is the best way to avoid getting caught in a trap. Before we move on, remember that the key to these strategies is patience and confirmation. If you rush in without waiting for clear signals, you might be stepping into the trap yourself. Now, let's shift gears and explore strategy 2, a technique that takes advantage of the fake-outs orchestrated by the big players. Strategy 2, which we call the silver bullet, the institutional fake-out. In a world of trading, big players need liquidity to move the market, and one of their favorite tactics is to create a false breakout. They push the price just enough to trigger a reaction, then reverse the move to capitalize on the misdirected retail orders. Here's the playbook for this strategy. Liquidity sweep. Watch for a sharp price spike that sends the price beyond the day's high or low. This sudden move is designed to sweep up liquidity, tricking retail traders into thinking that a strong breakout is underway. Market structure shift. Shortly after the initial spike, you'll notice a sudden reversal candle that breaks a key level. This reversal is the signal that the breakout was fake. Enter at the gap. Once you see the reversal, look for a fair value gap, a clear sign that the market is ready to move in the opposite direction. This gap becomes your profit zone. Let's put this into perspective with a practical example. Picture this chart during the London session. The price rallies sharply past the session's high, and many traders jump on board, expecting a continued breakout. But then, almost as quickly as it happened, the market reverses. Instead of continuing higher, the reversal candle signals a shift in market structure. Smart money recognizes this and starts selling into the rally. At this point, you would enter a short position into the fair value gap, setting your targets at the day's low. The result? With a favorable risk-reward ratio, often around 3-to-1, you're positioned to profit from the ensuing move. The silver bullet is all about being precise. It teaches you to differentiate between genuine breakouts and fakeouts orchestrated by institutions. By recognizing that initial liquidity sweep and then confirming the reversal with a fair value gap, you're not just trading on a hunch, you're trading with data on your side. I hope you're finding these strategies as insightful as I do. If you're ready to level up your trading game and stop second-guessing your entries, hit that like button, subscribe, and remember to comment below. Now, let's dive into strategy 3, where we catch trends before the majority even notice the shift. Strategy 3 is known as change in state of delivery, or CSD, the early reversal signal. This method is designed to catch the moment when a strong trend starts to stall and then reverse. You've seen it before. A market in full swing suddenly shows signs of exhaustion. It might seem random at first glance, but there's a method to the madness. The key steps for CSD include momentum breakdown. Look for a close that goes against the prevailing trend with noticeable force. This isn't just a minor correction. It's a strong indication that the current momentum is fading. Retest the ruins. Once the trend begins to falter, what was once a support level may turn into resistance, or vice versa. This retest of the previous trend structure is a critical confirmation signal. Volume clues. Volume often tells the real story. When you see a fair value gap form alongside these other indicators, it confirms that institutional players are participating in the reversal. Let's illustrate this with a gold chart example. Imagine a bullish trend that's been pushing higher, only to face a sudden stall. The price closes lower than expected, breaking the momentum. As the market retests the failed support, which now acts as resistance, a fair value gap appears, indicating strong institutional involvement. This setup is your cue to enter a short position. You're capitalizing on the market's early reversal before the larger crowd catches on. One of the most important lessons with CSD is to pair it with higher time frame levels. This multi-time frame analysis not only strengthens your entry confirmation, but also helps you see the bigger picture. When you combine the early reversal signal with an understanding of broader market context, you're in a much stronger position to predict where the market is headed next. We've seen how powerful early reversal signals can be. By combining momentum analysis with key price levels and volume clues, you're able to catch trends before they fully reverse. Up next is our final strategy, one that uses a classic tool with a twist to pinpoint your entry timing with surgical precision. Now let's talk about strategy 4, the optimal trade entry. This method harnesses the power of Fibonacci retracement levels, a tool many consider the secret weapon of institutional traders. Fibonacci isn't just for technical analysis gurus. It's a practical way to identify the precise pullback zones where trends are most likely to resume. Here's how you can implement it in your trading. Draw fib levels. Start by identifying the trend's beginning and its peak. Draw the Fibonacci retracement levels along this move. This gives you a map of potential retracement zones where the price may bounce. Wait for 61.8% to 78.6% retrace. These levels are known as the institutional buy zone. They indicate where the pullback is deep enough to offer a high probability entry, but not so deep that the trend is likely exhausted. Stack confirmation. For an extra layer of confirmation, look for a fair value gap within this zone. This gap confirms that the institutions are not only waiting, but are actively involved in setting up the next leg of the move. Imagine a scenario in an uptrend. The price pulls back to a Fibonacci retracement zone that falls between 61.8% and 78.6% of the previous move. Within this zone, you spot a fair value gap, a clear sign that the market is preparing for another upward leg. By entering at this point, you're effectively minimizing your risk, as your stop loss can be placed just below the gap, while your potential reward is maximized as the trend resumes. The beauty of this strategy is its precision. When you combine the timeless Fibonacci retracement with modern insights like fair value gaps, you're crafting an entry strategy that is both time-tested and responsive to the market's current behavior. To wrap things up, let's recap the 4 confirmation strategies that can transform how you trade key levels. Turtle Soup. Take advantage of false breakouts by waiting for a reversal into fair value gaps. Silver Bullet. Recognize fakeouts by spotting liquidity sweeps and market structure shifts. Change in state of delivery. Catch early reversals by monitoring momentum breakdowns and retests, supported by volume signals. Optimal trade entry. Use Fibonacci retracement levels combined with fair value gaps for precise pullback entries. Each of these strategies gives you a unique edge, a way to turn those key levels into actionable, profitable trades. Which one will you try first? The answer lies in understanding your market, practicing your entry timing, and always waiting for that confirmation. If today's video has saved you from making another bad entry, or if you've learned something new, hit that like button, subscribe, and share this video with a friend who needs to elevate their trading game. And don't forget to drop a comment below. I'll be shouting out the best strategy ideas in my next video. Thank you for joining me on this deep dive into entry confirmation strategies. Until next time, trade smart, trade with confidence, and remember, trade confirmed, not confused. Happy trading, and I'll see you in the next video.